Good time to get in George Joseph from Ask Investment Managers for a quick fundamental check on the market. George, so far the earnings season has been fairly good. Despite the volatility that we're seeing in the international markets, we still have Brent holding at around 93. Not a big problem when it comes to all the factors, but what suggests the market's inability to go higher? Because even the FII selling has come down, if not turned into buying. I mean, July was okay. This month so far also not particularly bad.
Yeah, so well, it is a very interesting time. Markets have been dilly-dallying for the last 2 years in this range. Small caps and mid caps have been doing reasonably well because of the mutual fund flows have been very strong in the last couple of years, and huge amount of money has been collected in that space. FI selling was the biggest, as you rightly mentioned, was the biggest selling point, and because of which the large cap segment was underperforming massively. Now that has tamed down, and there is an expectation that the valuation or the emerging markets within emerging markets, India positioning is much better compared to 2 years back. So some flows can come back, and also currency being reasonably stable. I think we are in a good situation where the large caps can come back strongly. So that's the way I think about the markets at this point in time.
Okay, you think the large caps can come back strongly. But George, good morning. Let me quickly ask you about this whole bunch of new listings we've had in the last couple of months, and they've mostly done very, very well. I mean, from Shiprocket, Milky Mist, Dhoot Transmission, there's a whole bunch of them. Anything in this particular space that you like?
We generally think from a little bit longer perspective, next 3 years, what can actually work. And if you look at from a quality, growth, value, and proven quality, growth, and value, or valuation where it is very, very attractive, that intersecting point is the most interesting one for us. And what we look at this point in time from next 3 years, where we want to make money for our investors, the private banks, IT, pharma, and to a selectively the manufacturing and capital goods segment becomes the most better hunting ground for us. Whereas the IPOs in general, because the listed history is very poor, we need to have some clarity on, how the minority shareholders will be taken care over a period of time. All these things checks happens over a period of time, and then we take a more constructive view on these names. So new listing, not much of our interest at this point in time. And, we have listed companies with a proven history available at ridiculously cheap at this point in time, especially in the large cap basket from private banks and IT and pharma. So that is our most attractive bet at this point in time.
Oh, that's interesting. Private banks, IT and pharma. Private banks, one understands. Pharma also reasonably, understandable. IT, tell us more. I mean, what makes you so constructive?
Yeah, so if you look at all the answers are not there with us. Uncertainties looming still. What AI can do for these companies, and whether these companies death knell is on cards or not. People are all talking about it, but when we look at after a long underperformance and the valuations have become much more dearer, the new leg of growth in terms of AI-led transformation for many big corporations are kicking in, and that's where the new leg of growth for these companies can be visible. And that's what we could gauge from the commentaries of Infosys founders, or TCS annual report also suggests the same thing. So we are more constructive from that perspective, because these are very high quality businesses with good cash generation and also long vintage of growth displayed over a long period of time across the globe. And therefore, there is a good case for these companies to be looked at more constructively at this point in time compared to 2 years back. So 2021, these companies were obscenely overvalued. Now it has become very cheap. So because it's a B2B business, it goes through these ups and downs very frequently. And, that gives you an opportunity to invest with a little bit long-term mindset.
Okay, George. So what is not obscenely overvalued? I mean, apart from pharma that you've discussed, IT that you speak about, and large private banks, where would you put your incremental money?
So, we are looking at selectively some of the micro caps, which where actually the interest of the most of the market participants is poor, where we see a lot of good value picks. But again, it comes with illiquidity and it comes with a lot of thinking and understanding about the businesses from a long-term perspective. When it comes to mid caps and small caps, that is a pocket where we find the valuation is very, very frothy. Many companies, be it in defense space or others, are trading at 100 times, 140 times, 150 times EV EBITDA, and people are still buying it, thinking that they will turn out to be good investments. But we believe that that is a very, very difficult argument to make. And when you look at some of the earnings growth stories, obviously some of the paint companies, they've reported good numbers in the last couple of quarters, and I think the worst more or less is over for these companies. Probably 5 years of underperformance has already hit in. Maybe that can be interesting ones to look at. So we are incrementally warming up on some of the massive underperformers, which has been the case for the last 4 or 5 years, and looking at what is it priced in, and how the expectations are at this point in time. So we can see some of the good opportunities in that regard, be it in the banking, auto, engineering, capital goods, and we have to be very, very selective.
Well, very interesting comments coming there, George. Thank you so much. We appreciate your time here on CNBC TV18. Well, up next, let's